Hi everyone, welcome back to our channel. In today's video, we are diving into the Modified Accelerated Cost Recovery System, or MACRS, which is a key tool for tax depreciation in the United States. We will walk you through the basics, explain different property classes, and show you how to calculate depreciation with a real-life example. MACRS is a primary method of depreciation for federal tax purposes in the United States. It allows businesses to recover the cost of income-producing property through annual deductions over a specified life of the property. This system is beneficial because it provides larger deductions in the early years of an asset's life, helping to reduce taxable income. Depreciation methods. Under MACRS, there are two main systems, the general depreciation system and the alternative depreciation system. General depreciation system. It's 200 declining balance or 150 declining balance or straight line. For 200 declining balance, this method gives significant tax deductions in the early years. It's called double declining because the depreciation rate is double the straight line rate. For 150 declining balance, this provides a higher rate than straight line but lower than 200% declining balance. For the straight line, this method spreads the cost evenly over the asset's life. And for the alternative depreciation system method, it's used for certain property, typically resulting in a longer recovery period. Property classes. Different types of properties fall into specific classes with designated recovery periods. Here are some common property classes. Either 3-year property or 5-year property, 7-year, 27.5, and 39. For the 3-year property, there are tractors, tools, and rent-to-own property. For 5-year property, there are vehicles, computers, and copiers. 7-year property, office furniture and fixtures. And for the 27.5-year property, there is residential rental property. And for the 39-year property, non-residential real property. For our example today, we will be looking at a delivery truck, which falls into the 5-year property class, as we can see here. As you can see here, vehicles and trucks actually. The convention rules. Convention rules determine the timing of depreciation deductions within the first and last year of an asset's life. There are three main types: either half-year convention or mid-quarter convention and mid-month convention. For personal property like vehicles or trucks, we use half-year convention, and for real property we always have to use mid-month convention. So here for half-year convention assumes property is placed in service in the middle of the year. This is the most commonly used convention. For mid-quarter convention, it always applies if more than 40% of the depreciable property is placed in service in the last quarter of the year. And for mid-month convention, it applies to real property, like either it's residential or non-residential. Here for our example, imagine we have a delivery truck that costs $50,000. Using the 5-year property class and the half-year convention, we will apply the percentages from the IRS MACRS table to calculate the annual depreciation. Actually, it's very important to know how to use the table. Here for 5 years, there are different percentages correspondent to each year, as we can see here. For the first year, it's 20%, second year, 32%, as you can see, and so on. So for the first years, the depreciation percentage is 20%. We multiply the 50,000 by 20%, so the depreciation amount will be 10,000. For the second year, we used 32%, as we can see here. And for the third year will be 19.2% as per the table. and for the fourth year it's 11.52. Fifth year is 11.52, and for the last year is 5.76. By the end of the 6 years, the truck will be fully depreciated. If you like the content, please like and subscribe for more videos. Thanks.